Hello, everyone. Good afternoon. I'm very glad to be here with you again and to open a new awareness about work-life balance. I'm Andreea Șerban. I'm the chair of the Work-Life Balance Committee. And for those who are not members yet, I'm inviting you guys to join our committee, because here we have every month a different program that helps you to increase your awareness about the importance of well-being. And today we have something very special, something very rare that we don't used to think that part of the well-being is our financial reality. It's our financial organization. So I wanted so much to have this program and to incorporate in the holistic pictures of well-being. And I think it's very important to all of us to have this holistic approach when it comes to well-being. And I'm telling you some details about the program. It's going to be 1 hour. And you're going to receive the email with CLA with credits. And if you guys have questions and Q&A about the program, please ask the question in the chat, and the speakers, they're going to answer to your questions during the program or in the end. It depends how the dynamic is going to be. So today I have a privilege to have very nice guests and very useful speakers for our committee. So I'm very glad to make an introduction for Niraj Chhabra. He's certified financial planner and a practitioner in financial advisors. And he will share with us structure for different kind of lawyers, for different kind of needs for lawyers. And you're going to have a bunch of information regarding your financial tools, because it's all about having more tools here. So, and the second speaker, I have a privilege to introduce you, Suzanne. She's a famous attorney, and she's gonna bring us this awareness about the importance to make when you make changes in life. It's so important to bring the financial reality in your before making any change. When it comes to divorce, she's a famous divorce lawyer, so she will tell us more about the importance of financial awareness when it comes to make changes. So now I'm turn over to Niraj. So please, they're gonna tell you more about themselves, their experience, and turn over to Niraj. Thank you for being here, both of you, and thank you for making possible this webinar.
Thank you. I appreciate you inviting us. So thank you all for attending today's program. Today's program is titled Financial Planning for Lawyers, and it's a program that we put together. Our practice. My practice is Sidebar Advisors, and we're a financial planning practice that really specializes in working with lawyers. And we've kind of put together this the CLE to highlight some of the challenges that we have noticed our clients experience. Even the concept of financial planning for lawyers is really broader than it may seem. You think, okay, it's specifically for lawyers, but within the legal community, some people work for the state, other people work in-house, other people are solos, et cetera. So we're going to kind of try to make sure that there's a little bit of something for everybody throughout today's program. And Susan's going to be joining us, and I think she's in a unique position to kind of co-present, because not only is she a family law attorney and mediator, but she's also a coach, and she's also going to be able to see it not just from the client's perspective and some of the challenges that they may experience from a financial planning point of view, but also professionally. And as you probably realize to a certain degree, there's definitely overlap between your personal finances and your professional life, especially for those that are self-employed. If you're not getting your billables through the door, then, it's going to be hard for you to put food on the table. So we're going to try to highlight all of these different things and, just different things, different strategies that we've kind of picked up along the way.
I wanted to also say thank you to the Beverly Hills Bar Association and to Andrea for inviting us to be here. And Niraj, thank you so much for, piggybacking on your presentation, because I will say to you all, Niraj is really the financial expert here. And my role is really what he was mentioning before is I've really stood in the shoes in so many different roles in my 30 plus years of a legal career. I've been an associate in a firm, a partner in a firm, a solo, a owner of a firm, and then now I'm off into consulting, coaching, mediation, and training. So I've worn many different hats. And the one thing that I have learned is every time you change your hat, you need to sit down with your financial advisor. And so I knowing what Niraj has in this presentation for you all, I know just how valuable and helpful it's going to be. Andrea actually asked at the beginning before we got started here, what's that one thing that you're hoping people take away from this program? And from the start, my biggest goal for this, and anytime I talk on this subject, is sort of what I referenced before. And that is every time you make a change or in your career or in your personal life, as we go along, I've been doing this for 31, 32 years. Every time there's a major change in your life or a shift, or even just a stretch of time, I think our financial planner said, every year at least you should be reviewing things, but definitely when you marry, when you have children, when you switch firms, when your firm changes plans, all of that, it's so important that you keep all of the tips that Niraj is going to be going through here in mind, because things do change so rapidly for us.
So again, I apologize for the tech issues, but I wanted to start off by kind of talking about what financial planning is, because I think there's a lot of misconception about that. So most of the time when people think of financial planning or financial planners, they oftentimes associate it with a stockbroker or somebody who's going to be talking about investment planning. The reality is investments are one piece of the puzzle, but it's not the overall big picture. Investments are really just a funding vehicle for funding your goals. And everybody on this call is going to be in a different point in their life. Some people are going to be planning for retirement. Other people are going to be planning for their kids' education, starting their own firm, et cetera. So, like I said, the investments are going to be just a funding vehicle. We also want to make sure that we have enough cash, and how do we manage cash and liabilities? So part of that's going to include budget strategies. It's going to be including making sure that we have an ample emergency fund, things of that nature. Protection planning is kind of planning for the worst case scenario. That's going to include life insurance, planning for disability, estate planning, malpractice, things of that nature. And every attorney's favorite topic, how do we minimize taxes along the way? So when people think of financial planning, like I said, they often focus on this area, or they think about somebody who sold them life insurance a while back because they are also considered financial planners. The reality is financial planning is more comprehensive than that. It's very rare that people are looking at the big picture and seeing how their household budget impacts their protection needs or their investment needs or their tax planning. So, when we're doing a comprehensive plan, we really are being comprehensive and looking at the big picture, because as you're going to see throughout today's program, there are going to be periods of time where there is some overlap and some intersection between these various different goals. So that's going to be what we're going to be talking about today, just covering each of those areas in detail. So let's get started. Now that we kind of talked about the different areas of a financial plan, let's talk about the process. The first step of any comprehensive plan is going to be not only to identify your goals, but to prioritize. A couple minutes ago, I was just talking about how some people are planning for education, some people are planning for their kid retirement. I'm sure in an ideal world, everybody on this call would like to pay for 100% of their kids' education and make sure that they all go to Harvard without any student loan debt and still retire early and, have $1 million in the bank. But the reality is it's hard to do all of that. And some people are coming from different financial perspectives. So it's not possible to do it all. Some people are going to be able to focus more on one goal versus another. Maybe I'll give you an example. I had a client who was, doing very well, making probably about $600,000-$700,000 a year as an attorney. And one of his biggest regrets was putting all of his having paid all of his kids' down payments on their first home. In addition to the weddings that for the ones that got married, paying for college tuition, he also helped them with the down payments. And it meant he was 70 years old and still working because he didn't realize at the time that doing so would end up setting him back. Now, had he known this information, he may have reached the exact same conclusion or decision and said, you know what, it's important to me to make sure they're okay in life. And that would have been the case, fine. But not everybody's going to reach the same conclusion. Some people might say, I'm okay with paying for their weddings, but their home is on their own if it means I'm going to be retiring later. So again, not just identifying, but prioritizing your goals. Collecting information, meaning, collecting not only your 401k statements, your student loans, mortgage statements, employer benefits booklets, tax returns. It's very rare that people have everything compiled in one spot at the same time. So it's important to make sure that we're doing so, analyzing the goals and coming up with recommendations and implementing them. Once we do that, it's important to track your progress and modify the plan along the way. As Susan mentioned, there's a lot of things that happen in life, whether it's a job change, birth of a child, et cetera, that could make the plan need an update. So we want to make sure that we're staying on top of it and adjusting the plan accordingly. All right, so let's talk about some of the different areas. We drew that diagram and we started to talk about budgeting and things of that nature. So let's start by kind of talking about some of the issues that come up with budgeting. So if I were to ask the people on this call, how many people if I asked you all to raise your hands and say how many people have worked on a household budget before, I'm willing to bet almost every hand would go up. And if I were to ask you how many of you have deviated from your household budget before, I'm willing to bet almost every hand will go up. Some of the biggest things that I see that make people deviate from a household budget are the fact that most of the time people are doing a monthly budget versus an annual budget. So if you look at the left-hand side of your screen, you'll probably see that these are probably, when you think of your budget, these are the items that tend to come front of mind, right? So you're probably thinking about your mortgage expenses, your grocery bill, et cetera. Now that we're in July, if I were to ask you, how much did you spend around the holidays last year? Would you have that number readily accessible? Maybe right now it's easy for you to know how much you're spending on travel because we're in the thick of summer. But if I were to ask you in December, maybe you don't know the answer. So the point is that, there's a lot of expenses that come up throughout the year that people completely forget about when they're doing their household budget. And if you don't account for it and come up with an annual budget, it might be easier to deviate from your budget on a month-to-month basis. Whereas if you plan for it in advance, it's a lot easier to stick to it because these expenses could literally amount to tens of thousands of dollars throughout the year. Think about how much you spend on travel. Think about how much you spent on your kids' birthday parties, on anniversary gifts to your spouses, birthday gifts, et cetera. So they could easily add up. So it's important to do an annual budget, not just a monthly budget. Susan, did you have any thoughts on this or anything you want to add?
I did. Only this is so similar to what we do with our clients in family law cases, right? Where we sit down and I say, you need to come up with this budget. This is usually where people get that deer caught in the headlights look like, are you kidding? You want me to come up with it? And it's actually not as hard as we think it might be if you sit down and you're like most people and look at your credit card statements. And most of us now get annualized statements. And I actually tell them to go through there. And that's where it's going to jog your memory about a lot of the things that you spend. I have clients who own real property and just they think of how much it costs to mow the lawn, but they forget about cleaning out the chimney and trimming the trees once a year and all, bringing in the mulch for the spring cleanup and all that type of thing. The other thing that, for those of us who might be solos, we also have to remember that there's a business budget that kind of, in many ways, they cross over here, right? Like you may have budget items that are business expenses and personal expenses, and there's some gray area in there. I'm sure nobody ever claims a personal expense as a business expense improperly, but there's some gray area there that we also need to keep in mind as we go through our budgets.
Yeah, it's an excellent point about the overlap between personal and personal finances and professional finances, because especially they say as a general rule of thumb you should have somewhere between 3 to 6 months worth of expenses set aside in cash. But for those that are solos, those rules kind of go out the window. You probably want to have somewhere between 6 to 12 months worth of expenses, particularly if you're just starting off, because it could be a while before you start to collect a paycheck, right? If you're a PI attorney and work on contingency, maybe we need to go higher. Maybe it's 12 to 36 months because you could go years before you get a case. So it's important to, most of the time, solos are very good at managing their business related expenses, less so on the personal side. But as I said, there is some overlap because if we don't know how much we need to bring in on a month-to-month basis, we may not necessarily have enough in emergency funds in the event that we don't collect as much as we should be. We were doing this program for a group of solos one time, and they brought up the fact that having a strong emergency fund made them a better attorney. And when we kind of spoke to him a little bit further, he was saying that in the past, before he had money in the bank, he took whatever case came through the door. He had no choice financially. He had no choice. Or if it was a competitive situation, he was discounting his rates versus what his true value was because he needed the business. Once he had enough runway to be able to sustain himself and his family for a couple of months, he was able to say, this isn't the type of law that I practice. This is my rate, take it or leave it. So it made him a better lawyer just by having some more confidence in his own personal finances, because he was no longer coming from a place of desperation. He was coming from a place of strength.
That's a really significant point, I think, Niraj, because there's a huge difference, for the topic of this particular program and the Wellbeing series that Andrea and the BHVA are doing. There's a huge difference in a practice where you're taking whatever case walks through the door, or you're able to take those cases that truly resonate for you or that you really want to represent. I work with a lot of people doing training for many litigators who want to transition to a dispute resolution practice or a mediation practice. And the same thing holds true. If you're wanting to shift from, litigation to mediation, you really do need to have this nest egg that's going to help carry you over, or you're going to find yourself in that situation where you're still taking litigation cases to pay the bills, or out of fear that you won't have enough to pay the bills. So this having that correct amount set aside really frees you up to be able to make those transitions in your career if that's where you're headed.
Thanks. All right, so let's talk about, for those that are not solo practitioners, what we typically find is that most of the time people are taking their paycheck and they're directly depositing it into their checking account. From there, they have a fixed dollar amount going into their savings. These are practical suggestions. Some of them might be a little bit basic for some. They might be eye-opening for others. What we recommend that people do is flip-flop this. Have your paycheck directly go into your savings account, and from there have a fixed dollar amount going into your checking. So in our prior example, if we wanted to say that your expenses come out to $60,000, let's just use a monthly number, $5,000 a month, and your after-tax paycheck is $7,000. What we're proposing is put the full paycheck into the savings, and then have $5,000 kicked out on a month-to-month basis into the checking. And the idea here is that most of the time there's some psychology here, because when people see a $7,000 budget and balance in their checking account, they think, well, I just didn't spend as much this money. I could afford to get X, Y, or Z. And they're a little bit looser with their expenses because there's more money in the account than they're used to seeing. So that's part of it. The second is, if you think about when you typically get a raise, it's usually at the start of the year. If you go with the typical strategy, what ends up happening is you have the same fixed savings amount going into your savings every year, even though your paycheck went up. What ends up happening is wealth creep happens. Your lifestyle starts to go up. So what would typically have gone from a $5,000 a month budget, it becomes $5,500, but your savings stayed flat. So by going with the proposed strategy, it kind of forces you to keep your expenses in check for a certain degree, a certain amount of time. And at the same time, your savings is going to hopefully rise in proportion. It's also helpful for those that have inconsistent incomes. If you're a solo, or if you're married to, let's say, a realtor or something along those lines, it allows you to streamline your expenses in a way, even if your billables are not necessarily regular.
Yeah, this was something I learned from you, Niraj, and I have to tell you, I love this. We've just transferred all this. And for those who, right now I do so many different things. I actually have funds coming in from all different, my PayPal account, funds come in from that, the training programs, the podcast monies, things come in from so many different places. It's actually having everything just centrally deposited into the savings, and then just taking out the money that we need to live on or need to meet to the expenses has made a huge difference, especially for those with a peripatetic income.
All right. So, one of the most common questions I get, particularly from attorneys who are maybe at the earlier stages of their career, is should I put the money towards my 401k or should I put it towards my student loans? And even if I wasn't just doing this seminar for a group of attorneys, the answer would still be it depends, but it's the safety answer. It really does. It depends on a lot of different things. We talked earlier about what your different goals are. And if your goal is to retire early, maybe that's going to put a little bit more weight on the 401k planning versus the student loans. Another variable is going to be the interest rate. What could we expect from your 401k? On average, the markets do somewhere between 6 to 9% over multiple decades. If your student loan interest is, let's say, 3%, and we could get 6%, on average, then yeah, there's a positive 3% return over time. If you told me your student loans were 12%, now we have to rethink things. And maybe, it doesn't make sense to put money towards the 401k at the time. If there's a match, that's a different story. You want to at least take advantage of any type of contributions that your employer is willing to offer, because that's leaving money on the table if you're not, literally thousands of dollars. So you definitely want to make sure you're contributing at least up to the match. But, if you're going to make extra payments and trying to decide where it's better spent, it really does depend. And you want to take a look at the interest rates. Some people, right now it's a low interest rate environment, so it's probably a practical time to look into refinancing if you haven't. For those of you that are homeowners, one other potential strategy is, home values have obviously gone up quite a bit since over the last 12 months or so. So if you have a home worth $500,000 and a $300,000 mortgage leaving you with $200K in equity, and you have $50,000 of student loans, maybe we could take some equity out of the home and use that to pay off the student loans if we could get somewhere between 2 to 5% here and you're paying 7%. Couple things to keep in mind. Certain federal loans are actually forgiven upon your passing. So, if I don't have a cosigner on my loans and I pass away, nobody's obligated to take on that liability. Whereas if you do the strategy that's on your screen, there's a good chance your spouse is on the home equity with you. So, you're leaving them liable. My view is the likelihood of somebody passing away while having student loans is significantly less than the likelihood of them paying higher interest for a longer period of time. So, that's the probability that I would probably play, but, everybody's situation is slightly different. This could be a way to dramatically reduce the amount of interest that you pay over time. All right, so let's kind of talk about some of the unfortunately morbid parts of the conversation with regards to planning. So this is kind of thinking about what could happen and what some of the worst case scenarios are. So let's start with life insurance. And the reason we're going to do that is oftentimes attorneys they fall victim as targets to life insurance. People are trying to hound them and tell them that they need this type of insurance and that type of insurance. So hopefully by today's program, you'll get some clarity about what types of protection make sense and, how do you go about calculating the amounts that you need. So I'm going to use myself as an example. When I'm young and single and nobody's really depending on me from a financial perspective, my life insurance needs are actually zero. If I pass away, it doesn't, people will hopefully be upset, but besides that, from a financial perspective, doesn't impact anybody. For illustrative purposes, let's assume when I get married, I'm the primary breadwinner, and I want to make sure that my spouse has the ability to maintain her standard of living. Now, all of a sudden, there is a need for life insurance. And then we get a house along the way, and we want to make sure that the mortgage is paid off. So now, our life insurance needs increase. Then we have a child, and we want to make sure that their education is provided for. If we need to send them to daycare, we have enough money to send them to daycare, because if one spouse passes away, the other spouse is going to definitely be at work. So lots of different things to think about. If you're doing all the right things, meaning you're paying down the mortgage, you're paying down the student loans, you're paying for your kids' education, you're saving into your 401ks, by the time you get to retirement, your need should actually go back down to zero. For the T&E people on this call, I'm not proposing we get rid of the life insurance at this point. I'm simply saying that maybe we don't have a need. Now it's more of a want. We want to leave a legacy. We want our kids to have some money tax-free, or we want to minimize the estate obligations. So nobody's going to be hurting at that point because we've done all the things that we needed to. But the important thing to kind of keep in mind with this graph is this is an ongoing process. Oftentimes people will address life insurance at one of these junctures, but forget that things have changed since. To Susan's point, maybe, you were making less money at the time. Maybe you were living in a smaller home. Maybe you only had one child, and now you have two sets of Pampers, two sets of, daycare, et cetera. So, the peak of your life insurance needs is going to be after the birth of your last child. After that, your needs are actually going to go down, so the same way I'm sure you'll speak to this to a certain degree, Susan, about when people get divorced, they start to taper off the amount of life insurance they have because they have less of a, obligation at certain points. Same thing with your own personal finances. You may not need as much coverage. It's not to say that you get rid of it, but you just may not have the same needs that you did, leading up to this stage of your life.
Yeah, that's such a good point, because again, this always brings to mind for me that process that we go through in divorce, where we're talking about life insurance and the need for it. And it's always tied in those cases, or for the most part, tied to a child support exposure, a spousal support exposure, and trying to meet that. But each year that goes by, that the obligation, the payer and the provider of the life insurance coverage, their obligation will go down. So very often we will eliminate chunks of what they have to put in. But I think it's really significant what you said, Niraj, about people sort of will go out and get life insurance and that may be adequate, say, when you get married. But there's a huge difference between how much you might need when you first get married and what you need when you have a home, 3 kids, a spouse who's now been a stay-at-home spouse for a period of time. And many people don't add to their coverages. And the other thing is, as life advances for us, especially for term life coverage, it can be much harder to get the longer you wait to get it. So, you wait. There are certain thresholds, just I know with certain birthdays where the prices go up because now you're over 40 and things like that. So that's something to be aware of as well. Even if you don't have kids, but you're getting older, or, as an example, you may want to think about increasing your coverage if you're planning on having a family, because it may be more expensive to access that coverage later.
Yeah, or even if it's just for legacy planning purposes, maybe you're charitably inclined and want to leave a stronger legacy. So, Susan mentioned, term insurance. And one of the things that oftentimes we see is that people are oftentimes sold policies that may not necessarily be appropriate. So very high level, we're going to go over the different types of insurance between term and permanent insurance. Most of the time when people hear permanent insurance, they're often in their mind associating this with a whole life policy. That's just been the industry standard as far as what people think about. So what's the difference between term and home and permanent life insurance? Look at term more like renting a home and permanent more like owning a home. So when you rent an apartment, you have a landlord and you sign a 1-year lease that says, as long as I continue to pay you my rent, you're going to provide me with a roof over my head for the next 12 months. At the end of 12 months, what happens? You could walk away and say, okay, I'm no longer interested in living here. They could say you're no longer welcome to live here, depending on the state you live in. They could say that, we're increasing your rent $500. It's really all bets are off. That's very much what a term policy is. You're signing a 10, 20, 30 year lease with the life insurance company that says, as long as I continue to pay my premiums, you're going to pay my beneficiaries X amount of dollars in the event that I pass away. After that term, all bets are off. They could literally take the policy that you were paying $150 a month for and say you owe $1,000 a month now because you're 25 years older. So, that's the way that the term insurance policies work. Permanent policies are more like owning. So why do people want to own a home? It's typically because you could build equity inside of a home the way that you can't when you're renting. It's the same one with the permanent life insurance policy, totally made up numbers, but if it costs you $150 a month for a term policy and it costs you $350 a month for a permanent life insurance policy, maybe $200 is going towards the cost of insurance, but $150 is building up equity. So it's costing you more money out of pocket, but you're getting some sort of cash value build up over time. That's number one. Number two, this is your policy that's going to pay out at some point in the future. So term policies will run out after or expire after a certain period of time. Permanent insurance policies will not. So the cash value, they'll often refer to the cash value that grows inside of these as a rich person's Roth IRA. We'll get into Roth IRAs in a few minutes, but basically, a Roth IRA is money you put into an account for retirement. It grows without being taxed. And when you take the money out at retirement, it's tax-free. Same thing with these permanent life insurance policies where the money will be tax-free upon withdrawal. We've also seen people utilize these types of policies as a way to save for their kids' education. Attorneys, doctors, and business owners really like these types of policies because they could put the money into these types of policies without harming their kid from a financial planning perspective. It offers certain tax benefits, and the cash value inside of these policies are actually protected from litigators in the event that there is some sort of malpractice issue. So it does make it very attractive for a number of different reasons. All that being said, why wouldn't everybody just put their money into permanent policies? Because they're expensive. Remember earlier we talked about the idea of 4 different quadrants and trying to balance your financial lives. Maybe we don't have the money to put all of the money into a permanent life insurance policy. So hypothetically, if we have a $2 million need, maybe we get $1.5 million worth of term insurance and $500,000 worth of permanent life insurance policy. So it's a nice complement, in everybody's situation. Maybe some people will get 100% in term, 100% in perm. It really does depend on the individual situation.
People were wondering where they could get a hold of the slides. And so we've just been trying to get that information. It looks like the presentation slides will be included with the email that everyone receives with their CLE certificate.
All right. So, in addition to life insurance, like I said, there are other things that we need to make sure that we are addressing. With regards to life insurance, we oftentimes see that solo practitioners will go into a partnership with a partner. And, let's assume Susan and I decided to start a law firm together, and roughly we're both generating the same amount of billable hours. So we decided that we're each pulling in about $500,000 worth of billables, and, we're going to be 50-50 partners on the business. And we're going to say that the business is worth 1 times, the value of the billable. So it's a $1 million business. Oftentimes we'll find that attorneys will do a great job drafting these very sophisticated buy-sell agreements, but where we don't necessarily see come through to execution is how are we going to fund this policy? Or this agreement? So assuming that, we have this buy-sell agreement that says that if something happens to me, Susan will buy my share of the business off of my wife so she could retain full control of the business. Let's assume I do pass away, but she doesn't have an extra $500,000 set aside in her bank account to pay off my wife. Now we're going to have some issues because, my wife is probably going to want that share of her money, right? So that's where a buy-sell agreement will come into play. Susan and I would each take out a life insurance policy on one another. And, it would be for $500,000 in the event I passed away. She would be the beneficiary of that $500,000 and be able to write a check to my wife for that money. And, she will retain full control over the business. Now, where it gets muddy is if, let's say, Susan and I had a age disparity, or if there was an issue where I had certain health issues that may make me uninsurable. So now we have to come up with some alternative agreements. So maybe it's, I pass away, but I was uninsurable, and, Susan agrees to pay off my wife over a series of 10 years, taking a share of my revenue. It gets even muddier if it was me, Susan, and Andrea as the 3 owners, because now I have to take out a policy on Andrea as well as Susan. Susan has to take out a policy on me and Andrea, and, vice versa. So what started off as 2 policies now became 6 just with the introduction of one partner. So the other thing is to kind of reevaluate the value of the business. If you're a startup, we probably want to be doing this on a more frequent basis, or a fast growing firm. If you're more established, kind of consistent, maybe we don't have to reevaluate the business year after year. But, if we started off at $1 million with billables and 5 years later we're at $5 million, we want to make sure that we're addressing this appropriately. All right. So, if I were to ask the people on this call, what would you say is your most valuable assets? Susan, I'm sure you go through a similar exercise with your clients when you're listing everything. What would they typically say?
Yeah, it's almost always the house, or sometimes the retirement accounts, but
usually those are the answers that we get. Occasionally we'll have somebody that'll say our health. What people oftentimes forget about is their income. What's paying for their house, what's contributing into their 401k. It's their ability to earn an income. So for easy numbers, let's assume that we did a comprehensive budget and we found out that our expenses come out to $60,000 a year, and we make $100,000 a year. Typically, if you work for a major company, or not even a major company, it could be a small law firm, depending on the size, there's a lot. Usually when people offer group disability, it's 60% of your salary. So in the event that something were to happen to you, you're going to get 60% of your salary, or $60,000 a year covered. What's not taken into the equation here is that you have to pay taxes on this money. So if we assume 20% for taxes, all of a sudden your income, your take home is about $48,000 a year, leaving you with $1,000 a month shortfall on your day-to-day expenses. So it's important to address this. We talked about the importance of holistic planning. If you're doing things in silos, you did a household budget, but didn't necessarily tie it in with your disability, your insurance needs, you might be underrepresented here. So a couple ways that you could address this: take a look at your employer benefits. Some employers will allow you to pay for your own disability. Well, why would I pay for my own benefits if they're going to pay for it? You don't have to pay the taxes. You get to keep the full $60,000 tax-free. So that's the first thing. The second thing is, Susan jokingly said that, there's sometimes people will oftentimes have personal expenses that get, deducted off of their business returns. For the solo practitioners, keep in mind that when you're trying to get coverage for disability, it's based on what you declare. So we've seen cases where people will live a $400,000 lifestyle, but on paper, they're only showing $150,000. Well, guess what? You're only going to get coverage on this $150,000. And if something happens to you, and most of the time the business owner is the business, something happens to the business owner, your family is going to have to make a very dramatic change in their lifestyle if you're not getting the proper coverage. And most of the time, solo practitioners don't think to address this. They think about other areas. And have you seen this, Susan, with your clients?
I've seen it with my clients. I've seen it with my colleagues. I actually went through this just recently with a close friend whose husband was a surgeon and unfortunately was diagnosed with early onset Alzheimer's and went from a very robust income to zero because you can't have a surgeon who has Alzheimer's, unfortunately. And their coverage was inadequate. And it's been a real struggle for them. And he was a solo practitioner doctor. So very similar in many ways to what we would face as solos or small firm owners.
Did he have any coverage?
He did have some coverage, and it's limited for a time period, but thank God they had that. It at least helped them get through the first period of time. But as we all know, it's very hard to get on Social Security disability as well. So they're still struggling in that area as well.
Yeah. Which goes back to this slide, your needs do change over time. Maybe my guess is he got some coverage at some juncture in his life, but then his salary did go up, his coverage just didn't keep up accordingly. And, Alzheimer's is obviously a big, important part with regards to being a medical profession. And what I find is that you never have to convince a physician to take out disability. You have to fight tooth and nail to get an attorney to understand that, these things can happen to them, because oftentimes they think, well, I could always practice law if I got hit by a bus. But the reality is that that's when people think disability, they associate it with some sort of physical illness. They think of a paraplegic or somebody, who got injured in an accident. Most disability claims, from my understanding, are not actually due to an accident. It's usually because of some sort of skin or genetic disorder. Even if you think about if you're a litigator and, you do have some sort of disfiguration, more than likely, you're not going to be going to the courtroom as much, and while physically or mentally, you're totally capable of doing so, it does create a little bit of a bias, and people just naturally just don't do the things that they were able to do. So it is important to make sure that you're getting not only the right amount of coverage, but the right type of coverage that's going to protect your own occupation. So if you are a courtroom litigator, you need to make sure that the coverage you have is going to protect you as a courtroom litigator, because certain policies will say, well, maybe you can't be a courtroom litigator anymore, but you can still teach law, use your degree appropriately there, and now they're not going to pay out. So lots of things to keep in mind. Make sure you're reading the fine print and not just going for what may be the lowest cost coverage.
Right. And remember, that particular case that I just mentioned, he was only 56 when he was diagnosed with early onset Alzheimer's. So you also, I think we as lawyers tend to think that we can do some sort of practice up until the day we leave this earth, but that may not be the truth.
Yeah. So, to me, the extension of planning for disability, what happens when you retire, maybe we don't need disability coverage anymore. Now we need to start thinking about old age and, what could potentially happen there. So these are some general stats I'm sure you're all familiar with. You've probably read something similar. Now, how do we go about addressing the long-term care needs? there's really 4 different ways that you could do this. Number 1 is self-funding. Number 2 is family support. 3 is government support, and then transferring the risk to an insurance carrier. So let's kind of talk about what is involved with each one. So, earlier Susan was talking about when we ask clients what is their most valuable asset. You said that most of the time they think about the home, correct?
Yeah, it's the home or the retirement, almost always.
Yep. And that's usually the same answers that I would get. So let's assume you have a husband and wife, statistically speaking, not in every case, but if you had a husband and wife, statistically speaking, usually the husband needs care first, for a number of different reasons. Men don't live as long, number 1. Number 2, particularly with the baby boomer generation, there was typically an age disparity between the husband and wife, and the husbands were traditionally older. So it just makes more sense that the husbands would need care first. So if they needed to go to a nursing facility or any type of facility, we probably can't rely on the home as an asset because the surviving spouse is probably going to want to use that, correct? So yes, they could look into reverse mortgages, but just the sheer word typically, makes people apprehensive. So usually we can't rely on that. So that leaves us with the 401k. Let's assume there was a $500,000 balance in your 401k. And this was earmarked for retirement. Keep in mind that the purpose of this money is not to draw on the principal, it's to live off of the interest. So if we're generating 5% a year off of your portfolio, that's $25,000 a year. On my previous slide, we talked about the average day is roughly $100,000 for a nursing home, correct? So if we needed to take out $100,000 for the husband to provide care for the husband, how much is left after year 1? It's natural to think that after, this is supposed to say 401k. It's natural to think that after 1 year, it's going to be 400,000. It's probably going to be less. Don't forget, this is 401k money. It's never been taxed. So to net the 100, maybe we have to take out 150 and we're left with $350,000. So after 1 year, the surviving spouse, the wife, is no longer going to generate 5% off of 500. Now she's generating 5% off of 350. And now she has to live off of 70,500. Rinse and repeat, another 1 year. Now we're down to 200,000. Now, 5% of that is $10,000. So after 2 years, she had to make $15,000 worth of cuts to her lifestyle because they didn't have adequate planning. Now, they may be very comfortable saying that this pot of money, this $500,000, it was specifically earmarked for long-term care. That's one thing. But to say that, okay, well, we have $500,000 for retirement, we have $1 million for retirement. This is the cost of self-insuring. And I'm not saying it's wrong, but we've actually come across cases. There was one famous case in Pennsylvania, I believe, where the beneficiaries actually sued the financial advisor for malpractice for not recommending to their parents that they get long-term care insurance, and it wiped away their inheritance. So this was a real life case. And I from my understanding, they did win. I got to double check that, but this does happen. And this is the cost of self-insuring. Not wrong, but just something to be mindful of. When you think about family support, there's nothing wrong with relying on family, but just keep in mind that oftentimes it's not the person that receives care whose life is on hold. It's usually the people around them. I've seen cases where people have to make a decision about, having less children because they don't want to put their kid in the environment or they can afford it. Sure, Susan, you come across this on a regular basis. What kind of stress can having an in-law live with you put on a husband, on a relationship? Marriage,
Yeah.
So,
yeah.
That's the real cost of family support. Again, not saying it's wrong, but it's just something to kind of be aware of.
Well, and there's a huge strain to being a caregiver, right? If you're having a family member, no matter what the age is, when you are putting family into that position of being the caregiver, you're now impacting their ability to earn, their ability to, continue to be in the workplace. So it has repercussions that go outward, like dropping that pebble into the stream, into the pond, right? It's not just that, oh, sure, you're going to go move into the house and be taken care of. It's now going to affect everybody else in that household.
Yeah. Yeah, I had a friend her goal was to build, I forget if it was schools or houses. Her goal was to build something for underprivileged children in Guatemala and moved down there before her father developed Parkinson's, and she had to run up, started taking a job that offered her flexibility, not her ideal job, but flexibility to come to and from to take care of her dad. Her sister was doing the same. He had his wife taking care of him. So he had the three women who loved him more than anybody else in the world taking care of him, but their lives were on hold, not his. I'm not saying his quality of life was great, but he was getting the best possible care he could have. So, that's, you just want to think it through when you think that you're going to rely on families for support. Being Indian ourselves, it's assumed that the oldest son is going to be responsible for taking care of our parents. And, I know that this was a delicate conversation with my mom. She was a nurse in a nursing home, and the assumption was that she was going to live with us. And that's totally fine. My wife and I were completely on board with that. But I wanted my mother to take out a long-term care policy because, as Susan said, it's stressful being a caregiver. At the end of the day, we haven't needed the policy, but the policy will pay for somebody to come in and out of our house to administer medication. If she needed somebody to bathe her, get dressed in the morning, do the things that shouldn't fall on, us, because we do have to get to and from work. We have a child to take care of, but the life insurance, the long-term care policy would provide for that level of coverage. So that would be point number four of transferring the risk to an insurance company. Long-term care insurance has a lot of, bad publicity, and a lot of it is rightfully so. There's different ways that you could do long-term care insurance. Number one is a standard standalone long-term care policy. This is one of those use it or lose it policies, very much like your home insurance. You never complain that, you didn't collect money from your home insurance because your home didn't burn down, but it's very much like people have a little bit of a different issue with long-term care insurance because it is use it or lose it. If you could pay into it for 20, 30 years and it's expensive, it's very expensive. If you don't use it, then it does go away, but it's there. That was the decision that, we felt was best for our family at that time. There wasn't a lot of other options, but that's what we took out. Now there's a lot more flexibility. People, the insurance industry understands that people don't like the idea of use it or lose it. So they've created these hybrid policies that oftentimes will work a little bit differently. So, earlier we talked about the benefits of a cash value life insurance policy. So hypothetically, you have a $500,000 whole life policy that's got $150,000 worth of cash value that's built up. Remember we talked about at some point, maybe you've outgrown your life insurance policy, because, you've done all the right things. Your kids are out of the house, they've graduated, you've paid into your retirement, you're good. Well, what's this death benefit for? Most of the time, I don't know. What's this cash value for? I don't know. I have money in my 401k. I haven't really thought about how I'm going to take that money out. It may be possible to take this cash value, roll it into a new policy that instead of offering $500,000, it gives you $600,000 worth of death benefit, even though you took this policy out 25 years ago. Now, keep in mind that there's been a lot of changes in the industry. So people will think, well, I have this health issue or that health issue. The insurance carriers are not comparing, 65-year-old you to 40-year-old you. They're comparing 65-year-old you to other 65-year-old yous. So it may not be as difficult to get approved as you may think. I'm not saying everybody will get approved, but now one of two things are going to happen. Either A, you're going to pass away, hopefully quietly in your sleep, and your beneficiaries are going to get a $600,000 death benefit. Let's assume that, you did need some care and, you needed it for 2 years and, the cost of care was $100,000 a year. You have $200,000 that you could exercise against the death benefit while you're still living. Your beneficiaries would just get $400,000 balance. So it is one of those things that will pay out one way or another. And, we're seeing a lot more people leveraging these policies for various different reasons. Usually it's just because they want to know that they're going to get their money's worth. Now, the reality is they're more expensive, so you're getting what you pay for. But, there's an emotional component to it, and people feel like at least they're going to get paid. So one way or another. So. Do we have any questions, Susan?
No questions, but if you do have them, please feel free to put them in the chat. We are monitoring, so we want to make sure that we're bringing you the information that's most helpful to you.
Cool. All right. So the last point that we wanted to talk about is, tax planning. And I think this is a very, very important consideration for the people on this call because your tax situation is going to evolve over time. If you think about where you are as attorneys, even at the start of your career, most of the time, you're starting your career in a higher tax bracket than other individuals. So you're not qualifying for the same benefits. For example, Roth IRAs, the way that they work is you put money in with after-tax dollars, they grow without being taxed, and when you pull the money out at retirement, they're tax-free. Unfortunately, most attorneys don't qualify for this. So we have to be very strategic on how we go about building a tax diversification strategy. So most of the time when people think about investments, they think of investment diversification, ignoring how important taxes can really be in your overall finances. So I'm going to show you two examples. Let's assume that, we make $100,000 a year and we're contributing 20% of our salary into our 401k. That leads, when you go to file your taxes, you don't say I made $100,000. You say I made $80,000. So it's helping you to lower your taxable income today. Most of the time, people will say, that this makes sense because you're deferring the taxes when you're in a high tax bracket to a point when you're in a lower tax bracket. That's conventional wisdom. The reality is it does depend. If you're in your peak earning years, yeah, you're probably in the highest tax bracket. If you're just starting your career or you're in, not picking on anybody, but if you're in the AG's office or some sort of public sector, you're probably making less money than you will be in the future. So maybe you don't need the tax benefit today and you're better off repositioning it into something that's going to offer more long-term tax benefits. So it is a moving target. So, this 20,000 is going to grow to 100,000 by the time you retire. You're going to pay tax on the 100,000 in the future. If you're in a lower tax bracket, it worked out great. If you end up in a higher tax bracket, then you delayed paying taxes on a smaller dollar amount and a smaller percentage to a higher dollar amount on a higher percentage. So this is a 401k. Let's look at the reverse. You you make $100,000 and you're contributing 20% of your salary into a Roth. For those that are, educated on this stuff, you can't put $20,000 into a Roth IRA, but for illustrative purposes, I just want to make sure it's a side-by-side comparison. You're walking home with $80,000, but when you go to file your taxes, you're still paying tax on the full $100,000. The difference is this $20,000 grows to $100,000. It's all tax-free at retirement. So again, if you're in the earlier stages of your career, or you think you're going to be in a higher tax bracket in the future, maybe we want to bite the bullet and pay taxes on a Roth IRA today, foregoing this if it becomes an either or situation. If you're able to do both, different story, go for it, pay for both. But just to illustrate the point, if we needed to live off of $100,000 a year at retirement and we're pulling all of it from the 401k, we talked about this, 20% for taxes, we're left with $80,000. But what if we did a split strategy where we had, 100,000 coming from the 401k, 100,000 coming from the Roth IRA. I'm sorry, 50 coming from each. Now we're still paying 20% for taxes, leaving you $40,000. This Roth IRA, you don't pay taxes on. So this is $50,000 tax-free. Now you just saved yourself $10,000 a year, not by saving more money, but by shifting your strategy around. This is assuming tax brackets are equal. If you're in a higher tax bracket in the future, you just made even more money. Now, oftentimes we'll hear the argument that, you will be in a lower tax bracket, as we pointed out. Don't think that this is just for the younger folks that are going to be in the lower tax bracket. We see this even in the last couple of administrations. Tax laws change, from one administration to the next, we see it. So the timing of your retirement can matter a lot based on who's in office, So if we talked about the idea of having tax diversification. If all your eggs are in one category, you don't have a lot of levers to pull once you get to retirement. Whereas if you diversify yourself from a tax perspective, you do have a little bit more options and flexibility, and you could choose to say, well, it makes more sense for me to take money out of account A versus account B, because from a tax perspective, this is just what makes sense. And I was fortunate enough that I saved enough into each category that that's an option for me. So, Susan, do you come across this with regards to, quadros and anything like that, where people want one bucket versus another, or how does that play in with divorce planning at all? Does it come up?
It comes up in pretty much any case where the parties have, a somewhat diversified portfolio, right? Where they have maybe 401ks, they have IRAs, and we still every once in a while run into people with pensions these days. But I think, really from that perspective of what you were talking about is, and what we talked about at the very beginning of all this is, I think this just exemplifies just how important it is that your tax and your financial planning be sort of at the top of your priority list on an ongoing basis. It's not something where you can sit down once, put a plan into place. And I think that the explanation you just had here with the 401k and the Roth is a wonderful example. That might change every year. It might change with every administration. It's really something where you need an ongoing strategy and probably a relationship with an advisor on an ongoing basis so that you can keep moving the pieces around to benefit your family.
Yeah, absolutely. It's definitely a process. And, even in our home state of New Jersey, I got an email this week that we could not deduct the contributions to a 529 plan. Other states can. I believe California does allow you to deduct, the contributions. Now, all of a sudden we can, but it's for those that are earning under 200,000. So you always have to kind of read the fine print. So these things change, on a very consistent basis. So very good point. I think we're at the 1 hour mark. So hopefully this was worth everybody's time. And, for Susan, thank you very much for presenting with me. I appreciate your feedback on this stuff and being able to show the practical side in addition to just the numbers, which we oftentimes lose sight of as financial advisors. But, we are available. If anybody has any questions, after the program, hopefully Andrea will get everybody our contact information. Please feel free to reach out to us with any questions that you may have. Additionally, in addition to doing these CLE programs, our firm does regularly host virtual attorney networking events. So if you're interested in those type of events, reach out to me on either Facebook or LinkedIn, and connect with me. And, I'm happy to have you at our programs. The next one's on Tuesday. So again, if you have any questions, feel free to reach out. Thank you, Susan. Any closing remarks?
Yeah, no, thank you also, Niraj. It was wonderful. I mean, such important information. And I really appreciate the tip about depositing into the savings account. As I said, I've already instituted it. I did put my email into the chat, Susan at Mostyn Guthrie. I love to speak to members of the bar, colleagues. If there's any way I can be helpful, please feel free to reach out. As I said, I've had many of the different hats that you might be facing or wearing as you go through your practice and through your career. So I'm happy to help if I can.